you never know who's going to pay the highest price, whether it's trade or private equity, which is why on any given deal, we're typically going out to both private equity investors and trade buyers. Because you might think, oh, trade buyers, yeah, look, there are just so many synergies, cost synergies, revenue synergies, that it has to be a trade buyer who's going to buy my business. And then, private equity buyer will come in from left field, maybe a US private equity buyer, and they will blow the competition out of the water.
Hello, everyone, and welcome to another episode of Investment Banking Decoded podcast with Tracxn. I'm Anand, and today I'm delighted to be joined by Peter Gray, partner at Cavendish. Peter has spent more than 3 decades advising business owners on M&A and the sale of private companies. Over his career, he has been involved in the sale of more than 70 companies. And he has also served as president and chairman of Oaklands International. What I find particularly interesting about Peter's experience is that he has spent so much of his career on the sell side, helping business owners understand when they are ready to sell, how to prepare for a transaction, and ultimately how to maximize the outcome. He's also a frequent lecturer on M&A and the author of the definitive guide to selling your business. So today, rather than just talking about M&A at a high level, I want to get into what actually happens when an entrepreneur decides, I think I'm ready to sell my business. Peter, welcome to the podcast. It's a pleasure to have you with us.
Thank you very much.
Peter, you have been doing this for over 30 years. When you look back at your career, what has changed the most about the way private companies are bought and sold?
Yes, good question. So I think there are a couple of things there. One is I was a lawyer for my sins, and indeed, I came to the UK. I'm Australian by birth. I came to the UK on secondment with a law firm, Clifford Chance. They seem to have done pretty well without me since I left, but I remember there were about 50 Australians and Kiwis there, so it was like a kind of home away from home. But I decided I hated the law and loved the country, loved London, so did an MBA as my escape route, and then joined Cavendish immediately after I finished my MBA. I think we were about 4 people then, now we're about 200. So I've never looked back since I joined, loved every minute of it. But I recall, in the early days, we were doing, 3 or 4 deals a year when I joined. Now we're doing about kind of 25 to 30 M&A transactions. What has changed in that time? Obviously, the relentless march of private equity. There were private equity funds, back when I joined Cavendish back in 1994, but the volume of money in private equity funds and the number of those funds has grown exponentially since then, and they now account for about 50% of the market. Trade buyers account for the remaining 50%. But the great thing about that, for an entrepreneur looking to sell their business, is that that private equity money, it has to be invested. Typically, the length of a fund is 5 years, so they've got 5 years to invest the monies, and then another 5 years to realize their investments. So they cannot sit on their hands and do nothing and say, the market's too expensive. There's too much uncertainty, political uncertainty. We're just going to sit on their hands. They can't do that. Bearing in mind their investors are paying them a lot of fees to do what they're supposed to be doing, which is invest in high quality kind of private companies. So that kind of underwrites the market now, irrespective of appetite from trade buyers, which is a brilliant feature. I think the other thing that I have seen since I joined is the rise of kind of US buyers and overseas buyers generally. So overseas buyers now account for well over 50% of the market, certainly by value. And indeed, I've just been looking at the stats before I came on, and even by volume of transactions, the overseas buyers account for greater than 50% of the UK market. And that is something that's changed significantly, and it's resulted overall in kind of higher pricing. The combination of that private equity demand and overseas interest from international trade buyers, US buyers in particular, has meant that we can maintain a really strong auction for most of our clients involving overseas buyers. They have to be of a certain size to be really attractive to a big number of overseas buyers, but as long as they tick that box, we'll get a lot of interest, and we'll be able to drive the price higher.
Fine, Peter. So, Peter, you mentioned that you moved from Australia to UK. So, about your early education, you did it in Australia or you did it in UK itself?
Yeah, no, I did a law degree and a commerce degree, combined degree in Australia, University of Melbourne, and then I came here and I kind of did my MBA as my kind of escape route, if you like, out of the law. Did that at City University. Yeah.
Okay. So, Peter, after your education, what was that turning point that made you join investment banks and become an investment banker?
Yeah, no, good question. So, I initially thought I wanted to be a lawyer. A lot of my members of my family were lawyers. So I did a law degree, which is what you do in Australia if you want to be a lawyer. And then joined Minter Ellison, an Australian law firm. They had an arrangement with Clifford Chance where they sent people on secondment. Unfortunately for them, no one ever came back from secondment. So I think they scrapped it eventually. They got the message that people were kind of staying put in London, and they were losing some good people. I don't include myself in that category, but yeah. So I then did 3 years with Clifford Chance in their management buyout group. We did nothing but management buyouts. We were very focused. When I joined Clifford Chance, we were number one in the market in that MBO segment, which was growing kind of rapidly at the time. Lost that mantle a couple of years later, but have always been a big player in that MBO market. But yeah, so I mean, the hours were punishing because we only worked on transactions. Back in those days, you would be working through the night. Probably hasn't changed that much, actually, on a regular basis. Sometimes 2 nights in a row. You just wouldn't get to go home. I remember instances where I was falling asleep at my desk at kind of 3 or 4 o'clock in the morning. Woken up by the cleaners at 5 o'clock, and you're thinking, that's not much of a life. And of course, on every deal at Clifford Chance we did, they also involved investment bankers, and looked across the table and thinking, those guys have got it much better than us. They work more sensible hours, and actually what they do is more interesting. It's more creative. So they're creating deals, whereas the lawyers kind of document transactions. So I thought that, that was by far a better option for me. But it would have been difficult to go straight from law in terms of skill set. Yeah, I had an economics degree, I did accounting and so on, but I felt it necessary to do that MBA to kind of tick that kind of educational box. And I remember I finished the MBA, and the first job I applied for fortuitously was with Cavendish. and the interviewer was Lord Lee, now one of the founders of the business, and he offered me the job on the spot, and I haven't looked back. Yeah, I mean that was a very long time ago, 94 now, and very unusual for someone to work for that length of time for one employer. I must be very boring. The reality is that I've never had any reason to leave. I love what I do, which is acting for entrepreneurs. At Cavendish, we do a little bit for private equity, a bit for corporates, but by far and away, the vast majority of what we do is sell-side M&A for entrepreneurs. That's what we love doing. It's a big occasion for them, often very emotional. It's one of the most important things they've done in their lives, so they require lots of hand-holding, and we're set up to deliver that. But you get a good result for an entrepreneur, and they are eternally grateful thereafter, because it makes such a difference to their future lives.
All right. So when an entrepreneur first comes to you and says, I think I want to sell my business, what are the first things you try to understand?
The first things we try to understand is, well, first of all, does it fit our criteria, I suppose, and I suppose we start at about kind of 15 million up to 200 million. But then, the first question that we ask is this business fit and ready for a sale? And does the owner want to leave the business on completion of a transaction, in which case he will have needed to implement a proper succession policy. He will have needed to hand over responsibility for the management of the business to the second tier management team. Has that process been completed? Has it even been started? Are there gaps in the team that haven't been filled? Is there an exposure to one or two major customers, customer concentration, which will make it very difficult to sell? Let's have a look at the numbers. What adjustments are there in terms of one-off exceptional items that under new ownership that they would not be incurred. So there's a whole kind of checklist of questions that we go through, because that preparation phase is actually probably just as important as the actual sale process itself. And you never want to go to the market unless you are completely prepared. And the probability of success is extremely high in terms of achieving your kind of desired valuation.
All right. So you specialize in preparing private companies for sale. So what are the biggest things business owners should do 12 to 24 months before they actually go to the market?
Yeah, so I think I mentioned the management team. Most of our clients do not want to work for another employer. That's totally kind of abhorrent to that notion. They run their own business for a number of years. They run their own show, being their own boss. They do not want to go and work for either a corporate or indeed even have a private equity owner. But in order to do that, as I said, they need to hand over control, remove themselves from the coalface of the business, well in advance of the sale. For instance, if they promote kind of a CEO within the existing ranks of the management team, that person needs to have been in situ for at least 12 months before the sale. So that we can show actually, the business has done well, it's thrived, it's continued to grow under the new management team. It's not something you can do, the day before a sale process. So that succession is hugely important. And then there are a whole series of what we call KPIs, key performance indicators, which you need to get right. So you need to evidence a really solid client base. If they're not contracted, then at the very least, they have come back to you year after year, so you can kind of trace back a longevity in terms of relationship with those customers. And then other factors. What are your margins like? Is there any capacity to improve your profit margins? Bear in mind that private equity will typically not look at a business unless its profit margins are at least 10%. So sometimes our role will be to work with the business to ensure that they get to at least that level, and that can be a function of scale. The bigger they are, operational gearing will get them there. It might be a change in the business mix. And in that regard, in terms of the business mix, we often get asked, well, should we just focus on one particular sector, or should we branch out and focus on a whole series of different kind of industry verticals? That will always depend upon the attitude of buyers, and that will differ from sector to sector. Should we make acquisitions? If you have a history of making acquisitions and successfully incorporating those businesses in your own business, then that is a big tick in the box, especially for private equity. They love having a situation where you've got a great organic growth story next to an acquisitive growth story, and you've lined up X, Y, Z as acquisitions, which you could make subject to funding after the deal. It's the easiest check that a private equity house will ever write, is to back a business they like, a management team they like, to do more of the same and make acquisitions. So easier said than done in terms of successfully making acquisitions at the right price and then integrating those acquisitions. But if you have done that, then you will go straight to the top of the pile in terms of what private equity will be looking for. Does it make sense for you to venture overseas? A lot of our most successful clients have done that very successfully, and especially if you think there's going to be a US buyer, if you have gone into the US market, achieved success. It doesn't have to be massive success. Proof of concept that your product or service works in the States, there's a market for it, then again, you will get a lot of traction with US private equity, because they will believe that they can help you kind of roll out in the States, and that has significant pricing implications. Then you'll get a higher multiple than you would if you were just in the UK market and just talked about the potential for international growth. I mean, in every information memorandum I've ever seen, there is always that potential for international growth. But if you've actually gone and done it and done it successfully, then it's an entirely different proposition. I recall a client we had called Goo, the desserts business, chocolate desserts business. The other thing they did, which was very clever before the sale, was to go into. They were in, a big player in the luxury desserts section of the UK market, to go into ambient products. Which again increased their market addressable market significantly from what it was initially. So it's actions like that can massively increase the multiple that an entrepreneur will get on a sale, and it's frankly it's the most interesting part of our job, and where we think we can add real value if we get to meet clients early doors, is in suggesting things they could be doing to kind of maximize value when they do press the button on a sale exercise.
Thanks for answering that in too much detail, Peter. Now coming to valuation, every business owner thinks their company is worth more than it probably is.
Yep.
What actually drives? So what actually drives valuation when you are selling a private company?
Yeah, well, a lot is clearly dependent upon the sector you're in. I mean, there are general kind of market forces, macroeconomic forces, which, from 1 year to the next will mean that the average multiple paid for private companies goes up and down. And indeed, if you look at the charts, there has been a kind of a massive, variation, from when I started in M&A to where we are now. Multiples on average have gone up appreciably. I remember there was a spurt, just before the global financial crisis, before Lehman's went bust, where the market was going gangbusters, 2006, 2007. Multiples were very high. They then dropped away after the global financial crisis. But then actually they've come back significantly and are now higher than they were at that kind of previous peak period, which was around the kind of 2006, 2007 period. So multiples on average are higher. But yeah, so much is dependent upon what sector you are in. For instance, if you're a technology business, you could be, in the kind of even at the top end of the market, kind of 20x EBITDA. I mean, SaaS businesses are sold typically on revenue multiples, but they often equate to very high EBITDA multiples. Anything kind of subscription-based information services. At the moment, we've got defense tech, which is seeing really high multiples. Anything AI related, really high, exceptionally high multiples. But then at the other end of the scale, you've got kind of FM businesses or construction services businesses, regional contractors, which might trade down around the 5 to 6 times EBITDA level. And the reason for that is quality of earnings, really. If you're a regional contracting business and you can have one bad contract and it can kind of wipe your profits out for the year, whereas if you're information services, subscription service, annual contracts, you've got great kind of visibility of earnings going forward, and you're going to be accorded a higher multiple. So much is dependent upon which sector you're in, and the trick for us is to try and position our clients in the sector which is going to pay the highest multiple. And in the past few years, that means trying to position businesses as tech businesses, be that fintech, medtech, regtech, agtech, every tech under the sun. We had businesses trying to convince people they were technology plays, not always successfully, but to the extent they could, then they would be accorded a higher multiple. Now, of course, it's all AI. Everyone is trying to position themselves as an AI business, everyone that can. There was a company recently, a quoted company, and they changed their name and inserted AI in the actual company name, and they got an immediate kind of 10% increase in their share price. It's reached that level of absurdity. Within your particular sector, you might have a band of multiples that you're likely to fall into, be that kind of 7 to 9, 10 to 12, whatever. The key for us is to try and get our clients to the top end of that valuation range, and preferably beyond it. So to exceed what we call the textbook valuation range, which is determined by two things. One, what other companies in that particular entrepreneur sector have sold for, and what the quoted companies in that sector are trading on by way of multiples. But you're always going to get an exceptional deal from time to time because the company, for instance, is growing so quickly, or you attract overseas buyers, and overseas buyers on average pay more for UK companies than UK buyers, sometimes significantly more. I mean, on average, if you look at the deals that we've done, I'd say 1 or 2 times on the multiple additional you will get if you secure an overseas buyer. But I've seen a 50% differential between the top US buyer and the top UK buyer. I've seen 100% differential. So coming back to your question, there are there is the scientific kind of textbook valuation methodology, which will position you at a certain level. And then what we are trying to do is to beat that textbook valuation by making sure that in terms of all the key value drivers, the KPIs that apply to your business, you rate highly against those KPIs, the key value drivers. And also, obviously, our raison d'etre is to go and find you an overseas buyer that will pay above the odds, above that textbook valuation. Sorry, that was a long-winded answer, but I could talk about that actually all day. We don't have that luxury, but it's a fascinating topic in terms of valuation and how you position clients to ensure that value is maximized and they actually get, if possible, more than their peers, more than their competitors would achieve.
All right. So if you were looking at two companies with similar revenue, similar EBITDA, what could make one significantly more attractive to a buyer than the other?
Yes, so similar EBITDA. What could make them more attractive? Certainly margins. The higher the profit margins a company has, the higher the multiple it will achieve, because the purchaser, be they private equity or trade, will see, okay, so if we increase turnover by X, we're going to get a really big chunk of that delivered as additional EBITDA. I would say the growth rate is really important. The higher the growth rate, both historic and in terms of the financial projections, the better. The more of your income from customers that you've got contracted with great visibility, the better. The higher the order book, if you've got an order book, the better. The lower the customer concentration, if you don't have exposure to any one or two particular customers, you will get a higher multiple. If you're at, say, 30% or above for one customer in terms of your revenue mix, that is problematic. That will hit you in two ways. One is it will reduce the number of buyers who will look at you, because they will model worst case scenario. What happens if we lose that 30% customer? What happens to your numbers? They will look at the downside risk, and they will mark you down in terms of an EBITDA multiple, or they just won't be interested. They will decide, actually, that's too great a risk for us to take on. So a really kind of well-balanced customer base with no particular exposure to one or two customers is really important. And sometimes it's difficult, because your lead customer will be wanting you to do more and more business with them, and sometimes it's annoying, but you have to soft pedal in order to ensure that percentage doesn't get over that 20 or 30% mark, and indeed focus your business development on other customers, such that it mitigates that customer concentration. But there are a whole series of things of key value drivers that will determine which company gets X multiple, which company gets Y multiple in the same sector, and those value drivers differ, I would say, from industry to industry. And what we do with the client is to sit down and work out what those key value drivers are. Where do they rank currently against those key value drivers, some of which I've talked about? Is it kind of red, amber, or green in terms of where they rank? And then how do we get, in the period up to kicking off the sale process, how do we make sure that we've got as many greens as possible, and make sure that in its kind of monthly board meetings and management information, that is tracked alongside the kind of the key financial metrics. In addition, how are we tracking in the lead up to the sale against those kind of key value drivers, and what do we need to focus on?
All right, Peter. My next question is, from a seller's perspective, How should an owner think about the difference between selling to a strategic buyer versus a private equity investor? Is the highest bidder always the best buyer?
No. Well, for a start, just getting back to square one. So you never know who's going to pay the highest price, whether it's trade or private equity, which is why on any given deal, we're typically going out to both private equity investors and trade buyers, because you might think, oh, trade buyers, yeah, look, there are just so many synergies, cost synergies, revenue synergies, that it has to be a trade buyer who's going to buy my business. And then private equity buyer will come in from left field, maybe a US private equity buyer, and they will blow the competition out of the water. So you never know, and we'll always have a guess as to who we think, in terms of, say, top three are the most likely buyers. It's very rare that we get it right, and that's part of the thing I love about my job, is that kind of uncertainty. We've sold businesses to in one case to an Estonian business. It was a seafood business we sold. They came from left field via our Estonian office, who knew they were acquisitive in the UK market, for instance. But getting back to your question, so if I'm an entrepreneur and I'm looking at bids, and for instance, I've got a number around the same level, some are private equity, some are trade, what best meets my objectives? Well, I suppose in the first question, before we even get to that, who is the most deliverable? And I would say, on average, it is a trade buyer, because they typically know the business better than private equity. They won't be surprised by anything they find in due diligence. And I would say, reputationally, they value their reputation as good buyers, and most private equity houses I would absolutely put in that category. But there are one or two which have a reputation for kind of gratuitous last-minute price chipping, and therefore, on balance, and this is just my opinion, others have different views on this. On balance, I would prefer to go with a trade buyer from the perspective of deliverability, which is absolutely key. And then in terms of the terms of the deal, I would say, on average, trade can result in a cleaner exit, but in terms of most of your money out, if not all of your money out, day one as a business owner, which is what most of them focus on. Certainly, I would recommend everyone focus on the upfront consideration, because that's the only element of the consideration which is absolutely guaranteed. As it happens, in the case of trade buyers, our clients have got a pretty good track record of achieving earnouts, but you can't absolutely kind of bank on that kind of post-deal. So potentially a slightly cleaner exit with a trade. But what I would say to owners is that, in that lead up to the sale, you need to ensure that you've executed that succession policy successfully. You've got a second tier, really strong management team in there, which is backable by private equity, and they've been in situ for some time. You've stepped back, for instance, as non-exec chairman, and you can evidence the fact that they have been running the business in your absence. And if you can do that, you've got a good chance of achieving a clean exit with either trade or private equity, without, in the case of a private equity bidder, having to roll over part of your consideration to shares in private equity. What private equity, though, are doing these days, they're being a bit more innovative, so that they will say, in a situation where the entrepreneur hasn't quite completed that succession strategy in terms of the handover of management control, they will say, okay, so what we will do, we'll require you in the business, say, for another year, and then you can leave. We require kind of some rollover, but potentially at the end of that 1 year period, you might be able to get some of that rollover back if it's, say, in loan notes and so on. So they're being a bit innovative now in terms of how they approach that kind of transfer of management control. So there's kind of a halfway situation where you haven't actually completed that handover at completion. You certainly do not want to hang around for the private equity house's exit in 4 or 5 years. So they reach a compromise and allow you kind of that halfway house scenario. But yeah, we are absolutely focused on maximizing the upfront, and to the extent we can, achieving 100% of the consideration on the actual exit on completion.
Perfectly answered, Peter. After being involved in more than 70 company sales, what are the most common mistakes you see business owners make when preparing to sell? And what's one mistake that can actually cost a seller a significant amount of money?
Yeah, so it comes down to that lack of preparation, and not doing that kind of preparation in the kind of lead up to the sale, in that kind of critical kind of two year period before you actually press the button on a sale process. But in terms of things that have gone wrong, upset the apple cart, I have seen just about everything in the years that I have been an M&A advisor. For instance, recently we had a situation where the company had affected a couple of share buybacks. Those share buybacks had been defective. As a result, the share register didn't reflect the true ownership of the shares in the company. The people that they thought they had bought the shares back from still actually owned the shares. And of course, if you're in the middle of a sale process, that becomes a real kind of ransom strip. And you go back to those people and say, oh, we thought we bought your shares properly, but we didn't. And we're prepared to give you a small token sum by way of compensation to get those shares transferred properly. Of course, they know they're in the box seat in terms of negotiations, and they can be disgruntled former employees. So that can have a massive impact. It can result in as it did in that case, on the sale process being put on hold for a period of time. But generally, it is a failure, I would say, to do the due diligence that a purchaser would do on you ultimately. Failure to do that on yourself before a sale process. So we will, as part of our preparation, we will give the owner of the business a list of the due diligence that the purchaser is likely to do, and we will say, yeah, do that on yourself to work out, are there any problems in the business that could potentially arise during the sale process otherwise, and let's fix them up front. And as I said, myriad potential problems. You don't own the IP that you thought you owned in the business. It actually belongs to an independent contractor, for instance, or there might be a lawsuit there kind of lurking in the background that really you need to resolve in the lead up to the sale. It creates uncertainty during the sale process, which you absolutely do not want. And even if you end up giving an indemnity to the purchaser for that piece of litigation, it's a distraction that you do not want. Anything like that, or any kind of tidying up that needs to be done has to be done well in advance of a sale process. Other things, the corporate structure may be too complex for the likes of a purchaser, so that needs to be looked at. You haven't properly thought through the taxation implications of the corporate structure that you have. Again, that needs to be sorted out prior to a sale. It is absolutely endless in terms of the number of things that can go wrong. But the vast majority of which can be kind of remedied upfront. Some things you can't. Some things you can't. Black swan event that like COVID, hits the market. No one could envisage that. Stock market, massive stock market crash, which impacts on multiples in your sector during the sale process. There are certain things that are beyond your control, but anything specific kind of related to the company, is within your control, and you need to sort it all out, before pressing the button on a sale process.
All right. Peter, I want to ask something about the emotional side of selling. We talk a lot about valuation and deal structures, but selling a business can be incredibly emotional for an entrepreneur. So how do you help owners navigate that side of the process? And have you ever seen a seller walk away from a transaction because emotionally they weren't ready to let go?
Yeah, no, absolutely. It is a very emotional experience, and bear in mind that the business may have been founded 20 or 30 years ago. The entrepreneur spent a whole lifetime growing the business, developing the business, and has a lot of friends within the business as well, and therefore wants to make sure it goes to a good home, over and above maximizing price. Typically, entrepreneurs want the business to go to a good home, a buyer that will look after the employees and will continue the success of the business, continue to grow the business, and honor the entrepreneur's legacy. But yeah, an emotional experience. So what do? We try and take as much of the heat away from our clients as possible. So obviously we're fronting the negotiations, and then we try and maintain a cordial relationship between the owner and the ultimate buyer right through the transaction. We'll take the heat. We'll go in, negotiate hard, while the owner sits in the background and is brought in on exceptional cases only, where there's something in particular that they need to agree on. And one of the worst things I see other advisors do is to wind their client up about how unreasonable the buyer is behaving, and that stresses people out and can result in the client kind of walking away from the transaction, because of the kind of emotional kind of ramifications of that. You never want to do that as an advisor. You will say to your client, well, this is normal. Or in the course of an M&A transaction, you will have the occasional kind of heated discussions. Is the buyer being unreasonable in terms of demanding what he's demanding on that particular issue? No, it's market practice. Don't let it worry you. We will negotiate. We're confident we can get to what is a market consistent position. But yeah, we're constantly fielding calls in the middle of the night, weekends, by entrepreneurs worried about what's happening on the deal. Is this a deal they should be doing? Is the purchaser right for the business? Usually emotional, and yeah, clients do pull out from time to time. Often at a fairly late stage, freezing in front of goal, and often it comes down to, oh, this just doesn't feel right. It's not to do with the price or anything like that. It's a concern about whether there is a cultural fit, with the purchaser, whether the employees that the owner has looked after for so many years are going to be looked after by the new owner. We've had one. I remember one situation where we produced an information memorandum, a sales document on a business for a client, and did a pretty good job on it, I have to say, and looked really good. And then the client said, "Wow, this reads fantastically. In fact, what am I doing even selling this business? I've got such a great story here, great growth story. I'm not going to sell it all. I'm going to continue growing it." We've certainly seen that. So the full gamut. if you're acting for a corporate buyer or a corporate seller or a private equity seller, there's no emotion in it at all. It's all about, I want to get rid of it, saying a corporate buyer, and actually even then the price often is inconsequential, more consequential for a private equity buyer relative to the return they're going to get and the price that they're going to achieve. But yeah, for an entrepreneur, yeah, there's a whole there's myriad objectives they're looking to achieve as part of the sale process, and price is always important, value is always important, and so it should be in terms of reward for what they've developed over a long period of time. But it's also those kind of softer issues. I had one, I remember, up in Cambridge. It was a defence business, and very concerned about the identity of the buyer. And we got a list of questions we had to ask of every buyer to make sure their intentions were honourable, and they were like, will you retain the company name? Will you retain the current location of the business? Will you make sure all my employees have jobs post-deal? But it went down to ridiculous things like, in the staff canteen, will you maintain the staff canteen? And will you maintain the menu on the staff canteen? Things like that. And it's quite amusing, actually. And we did that process. We went to every buyer and interrogated them in terms of their, how honourable their intentions were on all of these issues. And in the end, he went for the highest price. But actually, the guys that bid the highest price, again, an American buyer, paid a premium price for that business, Curtis Wright. They were the best on all the softer issues. So they were top of the score sheet on both price and softer issues. And typically, that is how it works. You are not making a choice between the highest bidder and someone a bit lower, which is going to be far better for the business. Typically, and fortunately, the highest bidder will also be the best on those softer issues, because that's what they're placing a value on, the quality of the management team, the brand name, etc. So fortuitously, you're typically not having to make a tough decision between foregoing some additional consideration and going for the best buyer qualitatively for your business.
Yeah, that's a very clear explanation, Peter. Now, coming to the current M&A market, looking at the UK M&A market today, what are you seeing from buyers that business owners should be paying attention to?
Yeah, so I mean, it's an interesting.
Are buyers becoming more selective about growth, margins, and quality of earnings? Where do you think the biggest opportunities are for the UK businesses over the next couple of years?
Yeah, so what we're seeing in the market at the moment, so certainly a lot of overseas interest still. As I said, overseas buyers have accounted for over 50% of company sales in the UK this year. In terms of the M&A market, at any point in time, there will be hot sectors and there will be less hot sectors and cold sectors. And in terms of what we're seeing at the moment, if you're looking at cold sectors, SaaS obviously has come off the boil with the SaaS apocalypse. So during COVID, multiples kind of peaked at around kind of 14 or 15 times revenues. They're now down to about kind of 4 times revenues, which is a massive decline. And what's happening there is that private equity houses are concerned that they invest in a SaaS business and then it's made kind of redundant by developments in AI shortly thereafter. And we've seen a couple of instances of that in terms of businesses that we have sold. So that is a cold sector, private equity sitting on their hands, entrepreneurs, owners of SaaS businesses are reluctant to accept those lower multiples. Consumer still pretty flat, albeit there are pockets of consumer that are doing well, health and beauty, wellness, for instance, business services rolls on unabated. And then you've got the kind of hot sectors like defense technology, massively hot sector. We've done quite a few deals. I think we're probably market leaders in the UK at the moment, and we've done a couple of kind of drone technology deals. For example, we've got an office in the US which just does defense deals, aerospace deals, and that is hugely beneficial because most of the buyers, investors in that sector are US. We actually beat Rothschilds on one recently on a pitch, because we had better sector credentials, and we're making kind of a really big play in that space technology. Obviously, we've seen the SpaceX flotation recently, but over and above SpaceX, there are a vast array of companies doing incredibly well in that really growing sector, and AI. So what I would say, if you're in a cold sector, it's not necessarily the best time to launch a process, but what you want to do there is to be prepared, Scout's motto, to launch a process as soon as sentiment for your sector returns. Recruitment, for instance, is the ultimate cyclical business, and what you need to be in a position to do is to switch on a sale process as soon as sentiment becomes favorable in that sector. If you look at travel, for instance, in that travel sector, so nothing during COVID, there was no travel to speak of. So that sector was just way off in terms of performance. But after COVID, all that pent up demand, everyone wanted to go on holiday. That travel sector boomed. We sold 7 companies, I think, in travel in the 2 years after COVID. But again, you had to be first cab off the rank, because what happened thereafter is that the corporates and private equity houses had made their deals, had done their deals in that sector. They were fully sated, and buyer interest waned, and it then became harder to sell companies in that travel space. So we're always advising people, don't give up hope if your sector's not flavor of the month at the moment. Sentiment will turn, but be prepared for when sentiment does turn to immediately kind of launch a process and be first cab off the rank and garner all the interest you possibly can from private equity and trade. So very sector dependent always. Ideally you want to go to the market when the M&A market is strong, and when sentiment towards your sector is strong. Clearly, that's always not the case. But what I would say is that timing is probably the biggest value driver. There is getting the timing right. Easier said than done, but if you can get it right, go to the market just at the right time, then you can maximize value. If you get the timing wrong, then all value in the business can dissipate. And we've seen that time and time again. People, spurning offers, not going to the market when they should have, and ultimately, the business becoming worthless. For instance, because a big competitor, like Amazon, has entered the market and eaten that company's lunch. Seen that time and time again. So in terms of timing, yes, size is important. The bigger you are, the better in terms of multiple. As you grow, the multiple you get will increase. You'll get more interest from overseas buyers, so that is very important. But it's only one factor. And the big thing we always say to people is don't leave it too late. Because if you leave it too late, all value in your business can disappear, which is why in a lot of cases, entrepreneurs will decide to sell part of their company. So maybe 30 or 40%, maybe 51%, whatever the number, hedge their bets, de-risk. Bear in mind that most of our clients have 100% of their wealth in their business. From a wealth management perspective, it's very unhealthy. And of course, if events go against them, and they lose that value, they're then kind of destitute. As I said, I've seen that time and time again. I've got lots and lots of war stories I could recount, where companies have not accepted, for instance, an offer they should have accepted and have regretted it afterwards. They've looked a gift horse in the mouth. So yeah, timing, a big factor. I haven't really talked about that to any extent, but it's something that, it's one of the very first things that we're advising clients on. Yeah, and it's something they will inevitably ask: is now a good time to sell? And that depends on a whole range of sectors, what's going on in the market generally, and what's going on in their business, and sentiment towards their sector in particular.
All right, Peter. Peter, you have written the definitive guide to selling your business.
Yes, I have. It's two editions now. Yeah, the second one was the even more definitive guide. It's actually, I've given it to someone else in the firm to do the next edition. Yeah, it needs some updating. But I actually did the first one. I remember I did that first one during the period after the global financial crisis, after Lehman's went bust, when activity levels slumped. I had a bit of time on my hands, and that's when I wrote that first iteration of that book. Yeah.
Okay, so if you could give one piece of advice from that book to an entrepreneur who is thinking about selling their company in the next 3 to 5 years, what would it be?
It would be seek professional help early, and along with your advisor, focus on those things that are going to enhance the value of the business in the lead up to a sale. You will know some of those things, but you absolutely will not know all of them. And also, to have an advisor on board who's got an ear to the ground in terms of what's happening in the M&A market, hugely valuable, because they can tell you, forget about that timetable we talked about. There is a bubble in your sector, which means very high multiples being paid. You should sell now. Or the advice could be, forget about that original timetable. Things are not looking good at the moment. So put your head down, focus on growing the business, and let's launch a process. Let's plan to launch a process in, say, 2 years' time. I mean, you have to be very flexible in terms of your timing, because events can happen which can make a sale process advisable at a certain time, or totally inadvisable. But you won't have all the facts at your disposal for you to make that decision. You need an advisor, in the M&A market, whose sole job it is to kind of focus on those things and the key value drivers which impact on valuation and impact on the ideal timing for a company sale.
All right, Peter. Before we wrap up, I would like to do a quick rapid fire round with you.
Okay.
So, best piece of advice you have ever received in your career?
That's a good one. I think it's do something you enjoy doing, and because your career endures for a long period of time. I never regretted doing the law, going into law. Learned a lot from it. Lots of great kind of disciplines and so on, and it's put me in good stead in terms of my current career. But if you're not enjoying your job, and I know lots of lawyers, former colleagues, haven't really enjoyed being lawyers, bite the bullet and change, because obviously, great money, but if you're not enjoying your job, there is just no point to persevering. And I've been very lucky at Cavendish. As I say, I've loved every minute of it. Haven't given a moment's thought to either doing anything else or practicing M&A at another firm.
Okay, what is the biggest red flag for a buyer?
I think it is dependence of the business on the owner. in terms of key kind of customer relationships, for instance, and that's where I see, buyers getting it wrong. Often they underestimate. So the succession policy is non-existent or hasn't taken place. So the owner is still in situ, gets a big pile of money, is not as motivated as he or she was, and therefore goes off the boil, even though he or she has signed up to a lengthy service contract. That is the thing that needs to be diligenced by buyers to the nth degree. To the extent it is the case, the continued reliance on that founder. They can be the heart and soul of the business. I've seen that so often in terms of where buyers go wrong.
All right. So, Peter, this has been a fascinating conversation. I think one of the biggest takeaways is that selling a business isn't something that starts when you appoint an advisor. The preparation starts much earlier. Thank you so much for sharing your experience and giving us such a practical perspective on what it really takes to prepare a business for sale and achieve a successful outcome. And for everyone listening, if you have enjoyed this conversation, please do follow the podcast and share it with someone who is building a business or thinking about their eventual exit. Peter, thank you once again for joining us.
Not at all. Thoroughly enjoyed it. Thank you very much. Yeah.